Good afternoon, everybody. Welcome back to the Opportunistic Trader. It is October 16th, and we're joined by Tom McEntee. Tom is an exceptional equity trader, option trader, and he's been speaking to us in the chat room and comes on once a week to talk about different risk-reward opportunities, how best to structure trades, or different opportunities to structure trades that are in a very good risk-reward probability for you. And with earnings coming up, he wanted to take some time, a combination today and tomorrow, taking a look at different earnings that are coming up, whether it be today or later in the week, and different ways to play them and look for a good risk-adjusted opportunity. So, Tom, I'll let you take it from there.
Great, Mike. Thank you very much. I would take issue with the word exceptional.
Exceptional, Tom. Don't be modest.
I would take issue with that. Okay. All right. Let's start with Mike wanted to really focus on some earnings plays because I think that's more relevant and it could be more. It may satiate the binary yearnings of a lot of people out there. So to that extent, we did a trade yesterday in Johnson and J&J. That's a small winner right now. Obviously, I'm looking for where I'm not going to put it up. We bought next week's OCK 39s. We sold this week's OCK 38s. Closed right in here, which it's closed. Closed right in. Obviously, at where is it now? It's going to be close to 138. The last I checked. 136.30. Closed right in here is real good for us because what's going to happen? The OCK 38s are going to expire worthless. The closer we get to 138, the better. And the OCK 39s are going to have more than 15 cents of premium. So anyway, that's a trade that took place. Here's a trade that I actually did today that I put in the chat. We gave two I guess favorites, darlings, if you will, of the option community, the day trading community, whatever. Netflix and IBM. So we'll start with Netflix first. Okay, I'll try to go through my process, and that word is in quotation marks, in finding a structure to put on for earnings that come out tonight. So the first thing I want to do is I want to look at a chart of the stock. So I see that Netflix. The first thing I want to do, let me back that up. First thing I do is I'll go back 8 quarters and look at the mean and median along with standard deviation. Extreme three. Now Netflix releases on Tuesday night, and typically it does. So if you're going to play the weeklies that expire on Friday, you have Wednesday, Thursday, Friday. You have 3 trading days left. So I want to look at a trade. So cognizant of that, I want to see the extreme plus or minus 3-day move in Netflix once it goes post earnings. So I went back 8 quarters. And it's got to be the extreme move. Now, obviously, you're not going to cover at the worst spot, nor are you going to sell at the best spot. That's not going. That typically doesn't happen. But I want to look at the extremes. Where has what's the biggest move this thing can be expected to make in this 3-day period? Now, in the last 8 quarters, there have been 2 quarters. The mean has been 12%. So with the stock here at 335. 12% of that is about $40, right? 33 and 6 stuff easy. That's my guard dog.
Doesn't like the trade apparently.
He thinks it's a dog. So I bought. So I'm looking for that would translate to roughly about a $40. Okay, but interesting enough, the median, which I think might be more relevant in Netflix's case, is about 9.5. This is for the last 8 quarters. I'm just trying to think. 1, 2, 3, 4, 5 of the quarters, 5 of the 8 quarters, 10% or less. So you've got some outliers in there. You had a 20% mover, I think, 3 quarters ago, and a 23% mover 8 quarters ago. So I'm going to structure something. I kind of think that there's unfinished business. Now, this is probably subjective. Yeah, it's definitely subjective. I think there's unfinished business on the downside here. I think that I came out. We talked last week. I think there's 2640 in the SPX coming up. Maybe sooner. I think we might have fulfilled. I think we fulfilled our upside target in SPX right here. This was Thursday's high. As you notice, I've been selling stock up in here in the spiders. I've been waiting a couple of days for that. So that said, it'll probably trade 284 in about a minute and a half. So here's what I want to look at. I think Netflix has unfinished business. It traded 310, I believe, on Org 22. if you I'll put up a chart here. I think it was Lord 22. It was a Monday. Let's see, 1 year. Full chart. Okay. Right here. This low right in here. It was 310.13. I'm sorry, I thought it was 310.13.
So
310 spot 93.
Let's just even start with it. What's Netflix? What's the option market pricing in for the move today? 10%ish move?
Right now it's about 33, about a 10% move, which it's sort of in line with the median. And I'm willing to play the median because I think there's some outliers there that are skewing the results, skewing the mean a little bit higher. Now, the standard deviation is wide because you get disparate results in a small sample size. So the standard deviation is somewhere around 6.15. So anyway, boom, boom, boom. I think there's unfinished business down at this 310.93 level from 2 months ago, roughly. 310.93. And I've been looking at that. I'll look at two things in Netflix. I look at this all-time high of 423, and I look at this gap filler. Was this a gap filler low? No. So the most recent low, this is the April 5 low. What am I looking at? 289 was the number I had. There's a gap filler right here. Okay, I'm looking at this 292 level here from April 5. I don't know why I had 289. Okay, the midpoint of that was 130, about 65, about $358 is kind of where it got to up in here on a it got a little bit higher, but on a rebound. But I think also that if you look on a 2-year basis, it was this low 193. I think I have a low of 193 somewhere in here on a 1-year basis, right? What is this here? 193 to 422.30. I have a low of 193 coming in here at what am I looking at? No, with 193. Hold on one sec. Bear with me here. Oh, year on year. I'm sorry. I'm looking from the beginning of the year. The beginning of the year was trading roughly close. Yeah. 1228. End of year. Close 193, 192 spot 71. High of 423. That's 230. 423 minus 193. Half of that is 115. 423 minus 115 is 308. Kind of dovetailing with that 310 low on August 22nd. To that end, I think you got a good chance of trading down at a 308, 310 level, but I'm cognizant of the fact that it could trade $40 lower. And I want to give a structure here where I could benefit on a down move while availing myself of, look, vols high across the board, no question. And I'm buying Vega. I get it. I'm buying Vega by buying that out month. But I think that if I play my cards right, my homework that I've done is correctly, I think this level here on a down move should provide some support. Think it should provide some support, and maybe we drift down. That's why I gave a trade in here where I wound up buying the November 2nd expiration. November 2nd expiration, 300 puts. These are the November 2nd 300 puts. Like, once again, I'm on tape delay here with this particular screen, but it's got a lot of bells and whistles that I use. I bought the November 2nd 300 puts, currently available at like $6.80, and sold this week's Friday expiration 305 puts, about $5.70. So that spreads about $1.10. I paid $1.71 because I pay retail. So I paid $1.71 for that spread. Now, that spread here, the break evens on Friday. So what you want to do is, when you structure these things, is okay. I want to know what's the extreme move. I've got that. I want to look out 3 days because I know I'm short that 3-day option. Right, I'm selling Friday expiration options. I know I got 3 days to live with that thing, to be short that thing. So if I collapse volatility, I'm going to get aggressive here and collapse my November 2nd options to 34 volatility. Kind of aggressive. It probably should be somewhere around 40 because of general market conditions, etc. But I'll be aggressive because I want to look. I want to look at how much I lose before I look at how much I make. I'm one of those guys that figure, take care of the losers and the winners take care of themselves. So I knock it down to 34. So I'm going to assume the worst of it in volatility, and I have room on this trade between 320 on Friday. On Friday, I have room in the trade from 320 down to 297, and that's collapsing vol down to 34. Look, if the stock rallies, The spread's probably a rip up, but you're still going to have 2 weeks of optionality. 2 weeks of optionality, but it's probably a rip up. I'll grant you that if it rallies to 370. But now on the downside, you got room from 320 to 297, and I'll postulate that if we do trade lower, if we do press 310 or 320, the November 2nd options are going to be trading at 34 volatility. They're currently trading at at the money's are trading 62. It might be 42. So I think you're going to make some. You got some decent ups. You got a real decent real good risk reward in that trade. Now it's important also, and I put this in the chat, and I think Mike and Vince and Larry will let go of this. Trading a $300 stock, Netflix, and it's an inflated volatility. I mean, still, it's usually about a 34 vol for the last year. It's a $300 stock. It's different than a $30 stock. So if you're a 50 lot player in options, maybe you're a 5 lot player here, and just do it accordingly. Because I mean, obviously these things it's more expensive to pay. I got to pay $1.70 for that structure. If it was a $30 stock, I'd be paying 17 cents. Okay, so I would be size it up accordingly. You multiply the price of the stock times the option volatility, and that's that should be an indicator of your size. Because the spiders, for instance, last week, ancient history, right before or 2 weeks ago, we'll say.
So, but if I'm leaning, so I guess in Netflix, if I'm leaning short, what's the opportunity? If I'm leaning long, what's the opportunity?
If you're leaning short, this thing here is I'm just trying to leverage this 310 level. If we get down there, it's a home run. The spread's this spread will be about it should be about $4 or $5 at 315. You paid $1.78, so that's almost 2 to 1. That's tomorrow. It'll just get better as time goes on. Because what's going to happen here is you're going to get decay in the ones you're long, no question. But the ones you're long are 60 or 61 vol. The ones you're short are 99 vol. Now the theta on these things, I'll hit this up. I'm glad you asked that question. That's a great question, Mike, and that should help people. Let me see if I can get this thing to populate. What am I doing wrong here? There you go. Okay. It's not showing. Hold on one sec. What's going to happen in these 3-day options? The option you're selling is, like I said, $5.70. This thing is going to come in geometrically, not arithmetically. The November 2nd options are going to come in sharply, no doubt about it. But they're going to be a little bit more linear than the decay that's going to be present in the weekly options for obvious reasons. Inflated volatility. Hey, much to the thing that Larry talked about this morning. He's been talking about the Friday afternoon, 2 o'clock, the Monday afternoon expiration puts were the 2-day expiration puts were jacked. I guess weekend, people worried about the weekend, people reaching for stuff. And all of a sudden, when you get that heightened volatility and everyone buys it, all of a sudden that stuff comes in real hard, real fast. Now, it could have gone the other way, no question, but it didn't. So what I would think here is that you're going to make money on decay. It's a cheap short side look, leveraging the vol, the elevated vol in the earnings month. I'm trying to, it's fashion delta neutral right here. Obviously, the delta is going to change significantly once earnings are released. So we're just trying to leverage vol in the front tenor, the weekly tenor, the October 19 cycle with the one we bought in November 2nd. Okay. And on the upside, I would do the same thing. I would try, I didn't do a trade in there, but that's a good point. So it can go that way too, obviously. If you were going to look up, I would probably, where's the chart here? Where is this? This is the 200. That's the 21. Where did it break from? Right here. Maybe you look to do something around 380, 385 on the upside, something like that. Just thumbnailing it. I'll put it in the chat later, but these 385s are $1.55. I do about a Nov 2 395. This week's 385s pay about 70 cents for that thing. But let me work that up. I don't want to give you something off the top of my head. That might work if you're looking up. All you want to do is you try and fashion these things delta neutral and try and take it as much vol as, try and scalp out as much Vega or theta, I should say in this case, theta as possible. Okay, so that's Netflix. You have any other questions on Netflix, Mike, or anybody need anything there? Or
No, it looks like we're good there for right
Okay,
now.
good.
Might come back
Let's
to it.
go to IBM International. Larry and I go back to the days when you could take a chart of IBM and lay it over. I guess it was the Dow more so than the S&P, and it would just kind of mirror each other. It was amazing how it would follow. It was the stock, and the market would get shook when you had days where they missed on earnings. It'd be down 10%. And the big joke in the pit was, you got every house has somebody covering IBM. How could they all be wrong?
Hmm.
There's not one outlier. Not one guy thought down. Everyone thought up. So of course, they have the efficacy of Weatherman, which is amazing. Like everyone, if you're all in the same boat, if everybody's wrong, everybody keeps their job. If you're the only guy who's wrong, you're probably out of a job. You see how that works? So now here we go. Beam. Where is the chart of Beam? Now this is as you may or may not have gleaned from talking to me over these last 8 weeks. I'm a bit of a contrarian. So Beam, unloved, unwanted. You don't need it anymore. I don't know. The guys on CNBC are kind of divided about it, whether it's a service stock or product stock. Okay, what I'm thinking here is now. I mean, there's certain guys out there. I am by no means a technician. I just look at them quickly and try. I use a lot of fib retracement numbers. So anyway, I think. Someone else who knows charts better than I will can refute me and probably will probably be right. I think we got here as a head and shoulder bottom. I think it's coming in here. I think it's almost apparent. I kind of think I know I'm buying a stock that nobody likes. It's kind of like Facebook. Anyway, I think it's a head and shoulder bottom. I want to look up. In this thing, and what I'm looking for, and I do the same thing. I'm looking at this 154 levels in here. It may. I mean, low here. Yeah, this was a gap fill from 10.3 from 2 weeks ago. Maybe it's got outside to get to 161, but I want to look higher, and I want to look at this recent low. I think was it 137? Yeah, here we go. This recent low from. You guys can see all this, right, Mike? Obviously.
Yes.
Okay, 627. I could trade at 137 and a half, give or take, up to this 154 level. So that's roughly 145 and change. We'll call it 146. I went back and I did the same process. I went back for the last 8 quarters, and I got I take the close the night of earnings. So say if it closed right here at 144, and tomorrow it opened up at 151. Well, it moved roughly $6 and $6.70. So that's roughly, that's about 4%, right? 4% would be about 580 or something like that. So I said it's about a 4% mover. Okay, so now the last 8 quarters, this stock has had an extreme 3-day, once again 3-day plus or minus move of 5.6%, with obviously a much smaller standard deviation than you would see in Netflix, right? Because Netflix has outlier earnings type events, because it's obviously that one side is a mature company, blah blah blah. It's more, and it's a higher volatility stock. Standard deviation of 3.1. So what I look at here is that, interestingly enough, 1, 2, 3, 4, 5, 6 of the 8 quarters, the extreme move was 6% or less. So although it's the mean, there's a 7. If I went back more, it would show me the same thing. There's a 75% chance that the move is going to be 6% or less. So I fashioned it this morning with a stock trading somewhere around 141. I wanted to look at 5%. I said I got about $6 higher. I'm looking at the 147 line to sell, and I want to buy something. I want to buy something out 2 weeks, to finance that. I want to look longer. I want to sell something in the front month to finance that. So what I did was I bought the November 2nd, 149 calls, I believe. Yes. Currently available at roughly $2. There tonight as well. Everyone's coming. All the big boys are coming. Well, IBM and Netflix is coming out tonight. And I sold the 147. So I paid 15 cents for that. So I'm underwater. That thing's probably about a dime again. It's probably 25 cents against me because the stock has rallied so much. Also, the fact that for whatever reason, as you can see here, the back month stuff is starting to contract for whatever reason. I mean, obviously, I would think to, I guess, Larry's point this morning, that with volatility contracting across the board, they're getting in front of it with these stocks, with stocks with earnings coming out today. That's why I got filled, to my mind, so favorably on these things. I didn't know if I could buy them because I was worried about the volatility blowing up on me in the back months. If we got a decline today, we got a rally today. We got VIX approaching, still in backwardation. The VIX futures curve still in backwardation. But I'm able to buy these things at the price I want to buy them at, and that's fine. I don't care. I think I got an excellent chance of winning on this freaking spread. So that thing here is, I'm looking for this stock to get back to 140, right in here, 146, 147, 147. I'm going to get linear decay on these things here. I mean, I'm sorry, geometric decay on these things. They're going to be under pressure. You're going to get. I'll move vol down to. Let me move down to 22. This is a 52-week median. It vols about 17. I would move it down to about 20, 21, and you get and so this thing here is real good in between one. You're a winner in between 137 and 151. So that's a real. You got a lot of room there. You got a lot of room there, and you got a lot of room to be wrong. That's all we're trying to do. We're just trying to leverage the elevated front month, but now I think attractive back month stuff. Like if you notice, I put a trade in the chat 10-4, I think it was. I don't know. It was a Wednesday. 10-3, 10-3. And I do some technical work, a lot of negative divergences in terms of the market as a whole. All generals, no soldiers, blah blah blah. And the skew in most of these things, the skew, especially in indices, the calendar skew was ridiculous. Like all the front month stuff was just at 9, 10 volatility. Where the backs you could finance a cheap. You could finance a directional look utilizing front month options and selling back month options because you were getting paid to do it. Now, obviously since the big move of Wednesday, Thursday, things backwardated where the front month was higher, the nearer term tenors were higher than the back month stuff. So now it's flip flop, at least in these equities, where you're able to fashion some trades in here, taking a look and buying. You're buying contracted volatility in the back month, selling inflated volatility in the front month. Does that mean it's going to work? Of course not. But I think I got two of these. If I hit one, net you'll be a winner. So that's good. All we're doing is we're leveraging vol metrics in both of these, right? I went through every quarterly report. I went through every quarterly report. I gave you with the max move 3 days because I'm looking out 3 days because I know the trade doesn't end tomorrow on the open. The trade will probably end somewhere around Friday lunchtime. If that's the way things usually present. So I know that's how I have to live. If I'm long those things, that's what I got to tell. If I'm short them, more importantly, which I'm utilizing them as a financing weapon. You're going to be short those for 3 days. So I want to look at what's the extreme move, and I'll fashion it accordingly. Then I'll also take the technicals and fashion something around a fib retracement or an old gap fill or something like that. So that's what I'm looking at. So that's Netflix, that's IBM, and those are the two big ones tonight. We want to look at and we've got more coming out as the week goes on. Like I think also in the market here now you're getting what am I looking at here? Let me go back to my watch list. I think there's a couple interesting stocks here. Spiders. I'm short at 829 and 896. Maybe they extend to 939. Like I tell you, they go right through me like a hot knife through butter once I freaking sold. So, I think we just you're seeing certain things here. But now, now as vol comes in, now is the time to look to buy put spreads. Now you want to look to buy put spreads into spiders. Maybe if they trade up, what was Thursday's high? I'm sorry, so Thursday's high or Wednesday. That's what I've been keying off of. But, where is this thing here? What am I looking at here? Thursday's high was the 11th. 10.9 was 288. 10.10 and 10.11. What was the high there? This gap right in here. Yeah. I got 279.30. What do you see for the Thursday high? This thing's screwing up. I think it's 279.30. Yeah. What was the high? 279.30, somewhere right around here. 10.11. I don't know why I'm not getting it up. Okay, that's it. That's where I sold 829.96. Yeah, it's a $300 stock. I can't, you can't be that exact. I think this is where you want to look to buy put spreads. I'll put some in the chat. I think maybe we challenge up to. I don't even. Look. I'm bearish right here. I think this is the spot. I think you're supposed to get short here. I think you're fashioning some put spreads now. Now you're seeing now that as the vol curve, as the VIX futures curve starts to come into, it may approach contango before the end of the freaking day. Still slightly in slight backwardation. And you can buy some things because what you're seeing now is, and we talk about this a lot, and I think Larry talks about it a lot, and maybe I'm going about it in an oblique fashion. But what you have here now is, I know there's bots and stuff like that, and robots and stuff like that, but at its core, this freaking game is made up of emotion. It's fear and it's greed. Period. End of freaking story. And you'll see it. And you saw fear on Thursday afternoon, right at 2:30. Margin call, flush job, trade down at 27.10 SPX, 270 something in this. Like, right. I bought 273s. That was my number in there, I bought 273s. I was way too freaking early, but that's okay. I mean, you buy them where you want to buy them, you sell them where you want to sell them. It's still fear and greed, man. And when you saw Thursday afternoon when puts could be, you can name your price in puts. And even then, even to a lesser extent, you got people still reaching for them on Friday because of the weekend risk. A lot of weekends I remember. I remember the hanging chads. I remember going home short queues, not wanting to, just getting hung on the day and having them limit up after what was the girl from, what was the attorney general from Florida said it was okay and Bush was in. That didn't work out too well, and there was another weekend thing.
I was in college back then, so
it was November 2000.
It was a Monday morning limit up on that one.
That's right. There was Monday morning limit up. It was after Thanksgiving. It was almost positive. It was after Thanksgiving. It was a Friday after Thanksgiving. It was crazy. They just traded real sharply lower. I didn't want. I had a good day that day, and I wanted to flatten out. Couldn't get anything on the bell. And I was short a lot more than I wanted to be short. I don't want to be short anything, and whatever. You're taking the other side of people's bets. And I should have covered. I should have bought. I should have bought more than I did in the aftermarket, but it was like freaking tumbleweed at that point. At that point in time, and they just ran them up. And I just know Catherine Harris, was that her name? She was the Attorney General of Florida.
I'm not sure.
Hanging chads were okay, and boom, we're off to the races. Where the Nasdaq futures will limit up. So weekends to make. Brexit. If you remember, Brexit, we had a big down Friday. And this is the most amazing thing. And you want to talk about volatility? Vol was so pumped up in front of Brexit that day and into it that I think that following, a big down day Friday, was that June 16th, 2016. Don't quote me on it, somewhere in there. That Monday, and I've never seen this before. Maybe I'd have to go back to 08 and 09. But that Monday, the S&Ps were down 30 handles. SPX was down 30 handles, give or take. And VIX was down. Because it
was so pumped up, like you said.
It was so jacked. So, by and large, this thing's about fear and greed. And now you're starting to see greed come in. Now the buy riders are coming back. Now they're coming back. They're willing to accept nothing. Nobody was selling options the last 3 or 4 days. Everybody's looking to buy them. Right now, we're looking at. Now, I guarantee you're going to see guys on TV recommending buying stocks and selling these calls, and you're going to get a 4% return, out to expiration and stuff like that. So I think look, I'm already invested. I'm already invested. I'm short here. I'll look to get. I'll sell more if we go higher, but I'm looking to buy some put spreads. And now's the time you want to fashion because I do not think this down move is over. I think we got 2640 minimum on the downside of the cards. So it was just to the fact that look, I didn't think it was going to. You were going to get 8% in a week, and it was hard and fast. But that's where fear came in, and I think now you're getting disgust with volatility. Like hey, vols are freaking. You got to be nimble, man. You got to be nimble, and you got to It's not just about owning an option and selling an option. There's a utility of gamma. Gamma gives you the right to trade. Look, if you bought puts, last Tuesday, when we closed last Tuesday, what is that, the 9th?
Well, Tuesday we
Yeah.
actually it was Monday and Tuesday last week. We had frustrating kind of trading. The market didn't sell off. It was down midday, but then kind of came back, and then it was Wednesday that the market really moved lower.
Right. Okay. So we closed Tuesday. I see 287, 80, 287.40, give or take. Hey, end of the day, say you bought some of the freaking 280 puts. I mean, you had a chance, to buy spiders down at 270. Say you bought 275s. What are you paying for those puts out a month? You paying $1? You got to fight. You bought 275. You ain't got a $3. You have a $3 scalp. $5 scalp in the stock, and you bought 273s. They got to come back and get you real hard. It's the utility of gamma, how you use it to trade the stock. That's an important thing to realize. I mean, that is what you are paying for. I'm not paying $1 for a put option because I think it's going to $1.20. I'm paying $1 for a put option because I think I can trade around it. Period.
Right.
I don't really care where the option goes. I want to trade around it. If I don't get anything, if this thing doesn't move and I don't get anything to trade, I lost it. It's got no utility for me.
So
I
what were
think
the
here,
opportunities though? Like for instance, on Friday, this past Friday, volatility was really pumped up, and the puts, like the S&P was trading, let's call it a 2750 range. The 2500 puts, the 2550 puts that are expiring this week were trading all like $5. You almost what actually almost happens is that people that look to sell, or people that even look to get long and buy a put for protection, they weren't able to. It was too expensive.
absolutely, because I think what you have, and look, I mean, you watched this probably closer than I did. What you had here was the market was starting to take on that. I thought it was starting to take on that freaking late December 17, early Jan 18 complacency, where every dip was a buy. The pullbacks were getting more and more shallow, and buy riders were emboldened. Right, I'll accept less. I'll accept less for that upside call. Right, because I mean, there's only one direction. It's higher. So that's what I thought it would. That's what I thought the market was taking on, that type of personality. So I think now everyone's probably, look, I mean, you didn't get this kind of move because people were long volatility. Face it, right? You got this move because everyone's shorted, and guys like me or other guys who are market makers. I mean, when you get the move from 292 to 270, are you buying it at 270? Probably not. You're probably out of it. Say you waited halfway, probably out of it at 281. Now you're gone. But now maybe that short's still there. He's got to bid it up. So now the tail risk gets blown up, and people, there's also there's recency bias, if that's what you want to call it. There's recency bias going back to Feb, where now I'm looking. Now it's the end of the world again. So I got to go. I got to bid this stuff up, and then there's weekend risk, right? That weekend tail risk that nobody wants to sell. Because I mean, they have no interest in selling you that weekend stuff because it's a one-day thing. It's a one-off. They'd rather you go out. You would be better served if you were looking to buy puts or something like that, to go out a month or something like that, or 2 weeks, where these guys could sell you more meat, and where the market maker can sell you more meat, and then hedge it accordingly. To sell you that $5 put down 50 handles in a thing is like they really have no interest in that. And whether they want to do back spread it, I mean, that doesn't really grab them. So you got to realize what they're working for. So it doesn't really grab them. That's why stuff gets inflated. I mean, it's always going to be inflated anyway, because on a notional basis, it's inexpensive. So now when you put a little black tail, it's in quotation marks, black tail risk involved in it, even more so, it's going to be even more inflated than it normally would be. Would normally present.
Yeah.
So what I did there was, if you go back to the chat, look, here's a trade. Whatever. I mean, I'm as apt to be wrong as I am to be right. Look at I put in the chat Friday, Thursday. I bought 1x2s in IWM. All right. I thought IWM was the most oversold of the three, of IWM, QQQ, and SPY, Russell, NASDAQ, SPX. I thought IWM was the worst underperformer, or the biggest underperformer, I should say. So I buy 1x2s. Vol's inflated. Like I say this in the chat a lot, and this is what I'm talking about. You gotta buy the cheapest thing, whatever the hell it is. Could be the stock, could be the options. But on Friday afternoon, it certainly wasn't the options. Not by a freaking long shot. Now, I bought this spread. I bought the 158s, sold the 161s. I think I paid 13 cents, or whatever the hell it was, 13, 14 cents. I bought one, sold two. So it's 231 against the dollar right now. It's worth about 30 cents. Not a bad thing, I'm not, that's not a big winner because I mean after commissions, I mean you're going to be down about 15 cents on 14 cents as a winner. But still, that's what I'm looking at. Now, vol contracts even more. What do you think is going to happen? That spread's just going to expand because the upside calls are going to be under pressure, like they always are. So when you get down days when you get these hard downs, I mean the cheapest way to fashion an upside look is to do ratio call spreads. Do them in indices, do them in ETFs, do them in these liquid names you get in and out of. When you see this, and it's still on Friday, if I'm not mistaken, I see now the at the money's are the 158s, curiously enough. Okay, roughly. Okay. They're trading about a 17 vol, and the 161's a 15 and a half. So a skew is about, 1.5 or roughly 0.9%. You follow me? Now, Friday, that was flat. There was flat skew. Okay, so essentially those two strikes were trading at the same volatility, I think 18. So what I want to do is I'll buy one 18 vol option. I'll sell two 18 vol options. So I'm short Vega. So Vega comes in, I win. How does Vega come in? A nice rally. You give me a rally, this thing's going to collapse because I'm short two options, every one I'm long, and you got to price yourself. And I priced it out. I think when I did it, the stock was 153 or something like that. My technicals projected out to like maybe to 164, but I only went 2 weeks out because I think we could back and fill, and then maybe I'm a little bearish here. But it's important to structure these trades where you want to stay away from the fire because the spikes off of big down moves are freaking painful. I did some work for some guy over the summer, and he wanted to know how to best play a 10% decline in SPX. So my initial reaction, I think Larry would say the same thing because it's kind of intuitive from being in the crowds that long, is that I don't want to buy volatility here. I don't want to own it. I'll buy call spreads. So I said, I went back and looked at every type of hard correction. I forget what the exact parameters were. I went back over 22 or 24 of these over the last, since the March 11/11 thing, somewhere around that Fukushima earthquake. And I looked at, I buy a 70 delta call, sell a 30 delta call. And I went back and I said, okay, and I structured it where I had very hard and fast rules that if it was before Wednesday at noon, I buy the Friday expiration 70-30 delta call spread. And if it was after Wednesday at noon, essentially half the week is over, I buy the following week's 70-30 delta call spread, however it presented. And the returns were really good. The returns were somewhere around, I think, 41%, which were outstanding. So you got the 10% decline or an 8% decline, whatever the heck it was. You bought the 70-30 delta call spread, whatever it cost you, 3 days, 4 days, 10 days, or 9 days, you got back 41%. So the guy said, is there any, is there a way what if we didn't sell any options? I said, to me, it's like, that's heresy. So I said, okay. So I went and I said, what if I just bought the 30 delta call? Now that's just absolutely counterintuitive to the way I would approach it. But in fact, if you bought the 30 delta call, your performance would have gone to like 82%. It was incredible. So when I bought these were 30 delta calls, and I spread them with, at the time, I think there might have been 20 delta calls. So it's interesting that like most guys like myself who grew up in these pits and understand, are cognizant or aware, sometimes painfully so, of spike rallies off of hard down moves, that the way to play it, and it's been proven, I got a lot of data going back 24 such dates, that the way to play it is to buy the 30 delta, buy the out of the money call. Sounds crazy, but that is what has worked, and it actually outstrips the performance on a ratio of 2-to-1. So that's what I'm looking at. So I think the next decline you get, look to buy 1x2, look to do ratio upside call spreads, Qs, IBM, whatever the heck it might be. When you're getting paid to sell options, that's when you want to freaking sell them. Go ahead. I'm sorry.
No, I was going to say, yeah, exactly. Maybe put in Netflix back up again, because I wanted to just ask a question or two about Netflix specifically, just because it's a great example for today.
NFLX. Okay. Oh, you want to put the chain up?
Yeah, the chain. Looking at the options, you mentioned it looks like it's pricing in roughly $30 move, 10%. I guess the two questions are: one, if you're leaning bullish, you think that they're going to be beating earnings. What sort of ratio spread would you put on that makes sense?
A ratio spread here. Okay, well then let's. I mean, I would say that let's look at that 385 line because I don't want to give anybody a spread where they're open ended and to a binary event and they got to go run and freaking chase. Okay, so let's
even doing something where it's just a covered call or something, one by one covered call.
Yeah, that's fine. Okay, how about I would look to sell this thing 330, 50 cents, 392 and a half. Hold on, just give me 1 sec. All right, I'll just get. This is back of the napkin stuff, but I think it's definitely worth looking at. And I think you're onto something. 6. All right, here. I look at this here. 365 call, pay 6. I mean, I'm a little behind. 372 and a half, sell 390. 380, sell 235. You taking in what, a quarter?
So I'm sorry, 380. You're selling 235. What was the one you're buying?
I'm going to buy the 365s,
which are.
I want to sell. They're like. Go ahead. I'm sorry.
$6. Let's call it $6.
$6. Sell the 372 halves. This is a tree.
Mm-hmm.
Sell the 372 halves. Where are they? They're like 380, something like that.
Yep.
Sell the 380 call. So I'm spicing it out $7.50 each. All right. Sell the 380 call. We'll say 235. Say it's massive slippage. Okay. I'm taking in 15 cents. Right. I pay 6. I sell 380. I sell 235.
Yeah.
Okay. So I'm plus 15 cents. All right. My break even. I got room up to 380. What am I? 387.35. Right. 22. Yeah. I got room up to 387.35. You see how I figured that out? The width of the spread, they're all $7.50 windows. I got 7.5 to 380. I got 387.50 minus my debt. I'm sorry, I get to move to 387.65 plus my credit.
Mm-hmm.
Okay, so at 387.65, let's go through this. So maybe if I'm lying, I'm dying. The 365s are worth 22.65. The 372 halves are worth 15.15. Natural square 225, and the 380s are worth $7.65.
So in this scenario, one of the better outcomes is it's a nice earnings release and we trade up to 10% and we're kind of hovering at like 370 or 365, something like that.
Oh, look, I mean, the nirvana would be 372 and a half, right?
Right. Well, no, I'm just saying, but here's the question. Okay, you do this trade, earnings come out, it's a blockbuster number, and we're trading 390 bid today at 430. What do you do then?
What do I do at 390 bid at 430?
I'm just saying because you got about 2 days left on the options. How do you react to hedge yourself to that? Okay, I'm bullish, but now all of a sudden I'm short the spread. And what if this thing goes to 410, sort of thing? That's the sort of thought process. Like, how do you start reacting so you don't wipe away your profits, but don't, you don't overreact, but you kind of got to do something. So all of a sudden, if this thing runs to 400, 410, 420.
Well, I mean, the only way to get in front of that, I would not, I mean, I would live with it and see what happens because I think it would have already made the move. That's my opinion. But if that is what concerns you, and that's a valid point, you're absolutely right. So I don't want to cowboy anything here. And you're 100% right, Mike. Why don't we just buy like the 410 call, put it on top of it, pay a quarter for it. Now you got a dime debit. Now you capped.
Yeah, right there.
Now you capped, and that's fun, Mike. That's a great point. That's a great point. You're absolutely right. I don't want anybody cowboying anything here. I know I gave myself a lot of room, but you're absolutely right. So where's the ripper? Pay a quarter for those things. Big deal. So now you're in it for a dime. You still got all that upside.
Yeah.
That's a great point, Mike. And I think everyone should.
But what if? Okay, so if this thing does go out at 410, what is your loss on this trade, you would be losing, right? Because you're getting short above
Right. I'm
3.
going to be down. I'm going to be down $22. Right. Because I mean, the 365, 372 that's $7 my way, but the 380, 410 goes out at $30.
Right.
So I'm going to lose 30 minus the 20 minus the 7. So I'm going to lose $23, 23. So that's where I lose at 410. But I think to zero in on 385 is a pretty good risk reward trade. But that said, I'm looking. I mean, you want to look up? That's a great way to look up. And if you want to cap your risk, or I mean, you want to cap your risk, I'd buy those 410s. I just I mean, yeah, that's what I would buy. I would cap my risk with those 410s and let the chips fall with anything. But I think this thing's giving you ample risk reward. But
All right. Well,
I'm betting
that's the update for some options for some earnings today. We'll be looking forward to seeing what actually happens with those. My interesting thing is, on either direction, see how much of a leader Netflix is in the tech area, whether it beats or disappoints, to see what the NASDAQ actually does based on that. I mean, right now the NASDAQ's up 2.5%. We're up 180 points. So it's obviously a huge update, but I'm interested to see what sort of leadership Netflix has, with the FANGs and everything else as we gear up for more earnings.
Yeah. Okay. So I mean, I think Mike, it's we're going to be doing this the next couple of days. You want to do one tomorrow? I'm just trying to think.
Yeah, that would be good if you could do
Thursday.
it 1 o'clock tomorrow, or I could do Thursday. We could talk after. Either one works for me.
Let me see what's coming out. BMO. That's Trader Talk.
We'll talk after.
Okay, great. That's great, guys. I hope this was informative. Mike, thanks for your questions. The Netflix thing is great because it's all about, hey, risk is more important than reward.